What's up, guys? Welcome back to the channel. Ben Samulak here, talking about how to pay your house off early with insurance. Now, when you buy a home, sometimes you get those flyers in the mail talking about, setting up mortgage protection for your home. So, in that sense, a lot of people already set up an insurance policy. That's really all mortgage protection is. It's either a term policy or a whole life policy that you're using to designate to pay off to pay off the home if something were to happen, if you get sick, disabled, or God forbid you pass away. So people already have the concept of using some kind of insurance to protect the mortgage while they're making their, paying their home off. But, if you also, what I would have you consider is using an IUL, which is life insurance, but it has a cash value that grows to pay off your house early, potentially, and protect your mortgage while you're still alive, protect your family. So you don't need the extra insurance with the IUL because the IUL will cover the house in the short run. So if you pass away early, God forbid, the home is paid off and the family's taken care of. But if you live, then the cash value that's growing in the IUL can be utilized to pay off the home early, maybe 5 years early, 10 years early, 15 years early, depending on how much extra cash you're able to put into the IUL. But even with a small amount, you still can potentially at the end of once you pay your mortgage off, you're going to get all your premiums plus some cash value back. So even at the worst, if you set this up even with a smaller amount, instead of throwing it away with, say, a mortgage protection that is just 100% cash loss once you're done with the policy, this one will have cash value growing. So even at the minimum, you can set it up to where you get your money back, or some of your money back, if not, if anything. So, but typically with the way I set it up, you will be able to potentially pay your home off early. Or what some people do, once the home's paid off, they continue then because now you don't have the mortgage payment. So that mortgage payment can now go into the IUL and grow it even faster. Or you can pay your home off, and then whatever is in your policy, that cash value, you can then take that and put it on a second property and have a second property and maybe a rental property or just a second home, somewhere where it's tropical and warm potentially for yourself. Because now your home's paid off, you can potentially get a second home, a vacation home, or you can get a rental property. There's a lot of things you can do with that cash value. And if you were like wanting to put extra payments into your home, I would say consider maybe an IUL instead, because if you're putting extra payments in the home, if you die, say a year from now, your family gets none of that. You're probably going to lose all that equity because they may not even be able to sell the house for what it's worth, right when you just bought it, with all the fees and things you had to pay. And that extra equity could be lost even after 15 years. If you're putting extra equity into the home, people who do that, I would say think about an IUL as a different way to do it, because if you're just putting extra equity in the home, say 15 years later, say there's a market crash, home prices dip like they did in 2008, your house could cut in half. All that extra equity you put in there could be lost, right? Whereas if you're making your payments, building your cash on the side with the IUL, letting that cash grow, market crashes, home cuts in half. Guess what? Now you have some cash on the side to even make your payments to make sure you could stay in the home. Many people during 2008 lost their homes because the markets crashed. They lost their job. They couldn't make their mortgage payments. So not only did they lose the equity they had in there, they lost their whole home. So with an IUL, you have a safety net. You have extra cash there. You don't have to wait 30 years for you to pay the mortgage off. That money's liquid even after the first year. Within the first year, many times the way I set it up, you'll have cash value available to you if you needed it. So it's life insurance for your family in case you pass away tomorrow. It's a safety net if you lose your job in the meantime or get sick. It is you do have living benefits with the life insurance. So if you get cancer, heart attack, stroke, think about it. You're taking a loan out for 30 years. And if anything were to happen to you in those 30 years, that could really mess things up. That could cause you to lose the home. That could cause you to potentially have to dip into your retirement funds and pay huge fees, like your 401k. If you need that money in an emergency, you got to pay fees to get it out. Your IRA, some of these things are not as liquid. Whereas with the IUL, that money in there's liquid and it's growing, it's going up, or at least staying the same. It's not going down. Whereas your IRA, your 401k, if the market's to crash, those retirement vehicles usually go down as well. And now you're pulling out when your money's down. It's the worst time. So on this IUL fund, it's a safety net. It's life insurance if you die tomorrow. It's living benefits if you get cancer, heart attack, stroke, and you're growing that cash value. So you are kind of starting your infinite banking while you're paying your house off. And once the house is paid off, you already have that little nest egg set up. So you can either speed that thing up and get lifetime income for when you retire, or like I said, you can just use the cash, buy another house, to buy a rental property. There's a lot of things you could do. So that would be something that I would say consider using an IUL to pay your home off early, to start your infinite banking, potentially to have a second property, protect yourself in the short run. So if something were to happen to you, your family's protected. If something were to happen to you in the short run, you have liquid cash available to you as a safety net, so you don't have to dip into your other retirement vehicles, which would be, like I said, at the worst time and with the fees. So if you're interested in that, go ahead. You can go to bensamulak.com. You can email me in the comment box, message me. You can fill out a request form on my website, and I can answer any questions, show you an illustration, however you like. But feel free to contact me if you have any more questions. If not, thanks for tuning in. Hopefully the video helped.